Hello and welcome to Macro Matters, the economics and politics podcast from Aberdeen Standard Investments. My name's Paul Diggle, and along with my co-host Stephanie Kelly, we're guiding you through the macroeconomic and political themes which are driving global markets. And today we're talking about the European Central Bank strategic review, and in particular the role of the ECB and central banks more generally in the fight against climate change. And to do this, we're joined by Grégory Claeys, Dr Claeys, who's a senior fellow at the Brussels-based think tank Bruegel and an associate professor at the Conservatoire National des Arts et Métiers, CNAM. I hope, Grégory, I pronounced that correctly. And Luke Bartholomew, who's our senior monetary economist here at Aberdeen Standard Investments. So we're going to spend about 15 minutes talking about the strategic review that the European Central Bank is undertaking. And then in the second half of the podcast, we're really going to zoom in on the climate considerations, how the ECB and central banks think about and can tackle climate change. But Grégory, why don't we start with the background to the ECB strategic review? Why is the ECB going through this process of a strategic review at the moment?
Yeah, first, let me thank you very much for the invitation. It's great to be part of your podcast. As far as the strategy review is concerned, I think the main reason why they are having this review is basically because they didn't have one since 2003, which seems like a million years ago. Because since then, we have seen a lot of new challenges. We have had now two crises. Inflation has been too low for a while. So basically, it was needed to have a strategic review. And on top of that, it has to be said that most of the team was changed in 2018, 19, 20. Most of the governing council was renewed, both in the executive board, but also the national governors. So I think, and in particular, as you know, Mrs. Lagarde herself replaced Mr. Draghi. So I think it was really the right time to have this review, and also other central banks were having it, so it was difficult for the ECB not to do that.
Indeed. Now, our very first episode of this podcast actually was on the Fed strategic review. I mean, Luke, one of the big bits of the background has been the persistent inflation undershoot. Maybe you can say very quickly why that's happened and the challenge that poses a central bank.
Sure. I mean, I guess the most obvious reason, right, is that demand has been systematically below potential, right? So the economy has been structurally weaker, and so inflation is lower. And I think the reason the ECB has struggled to keep demand at potential, one of the main reasons, has been outside the issues of fiscal policy that we can also talk about, but fundamentally what we call the equilibrium interest rate, or the interest rate that's consistent with the economy being at full employment and inflation at target, has fallen significantly. And so the central banks across the world, the ECB in particular, finding themselves bumping up against what we call the effective lower bound. It's much harder for the central bank to stimulate demand at this point. And I think that is the main reason that we've sort of seen these low inflation periods, and then there's a sort of self-fulfilling aspect to that, right? That periods of low inflation embed lower inflation expectations, and the worry is that inflation expectations become very unanchored. And I guess one problem with systematically failing to meet your inflation target on the downside is that the price level ends up being, over the medium to long run, an extremely long way away from target consistent matters. The salient feature, perhaps, of a standard inflation target is that it's completely memoryless. It doesn't require that you deal with past incidences of low or high inflation. Every year, you just must simply meet whatever the inflation target is. And so that means if you consistently fail on the downside, you end up opening up a very big gap from where you otherwise should have been.
So a lot of reasons to have the strategic review now. And Grégory, it seems like an awful lot is up for discussion. This strategic review has a very wide remit. Can you maybe tell us some of the key points that the ECB are going to consider when as part of this strategic review?
No, indeed, the ECB wants this strategy review to be very comprehensive, and Mrs. Lagarde mentioned that she wants no stones to be unturned. So they are going to be discussing everything. But in my view, the main element that they will discuss is, of course, the definition of price stability itself. It has been quite controversial, the ECB one, very peculiar too, because they use this weird expression which is below but close to 2%, and they are the only one doing that now. The Bank of England has a simple definition of price stability. It's like 2%. The US is the same for the Fed. In Japan, it's the same. So they have this peculiar definition. So I think that's one of the major points they should touch on. But there are other important elements, like for instance, the toolkit. Since 2003, since their last review, they have been expanding the toolkit tremendously. At that time, you just needed to move the interest rate up and down, basically, to do monetary policy. Now there are many other tools, TLTRO, asset purchases, etc. And one of the problems that I see is that for some of the members of the governing council, some of those tools are still a bit controversial, in particular the asset purchases. So I think they need to make clear that there is a consensus around using those tools, that those tools are there for good, and they should stop using the name unconventional tools, because basically in the last 10 years, those have become the main tools of monetary policy.
Yeah.
I think discussing about the toolkit and what's consensual and what can be used is very important also for the market, so that they are sure that the ECB will continue using asset purchase. So I think definition, toolkit, and then there are other stuff like communication, votes. This could be clarified because the ECB is not very transparent in that, and I think they should do better about that. And finally, there is also this two-pillar strategy that was inherited from the Bundesbank. Now it makes less sense, so they should also take a look at that.
Yeah, the monetary cross-check, which they always sort of shoehorn into the press conferences, it seems to me. Well, let's go through a couple of those then. The price stability redefinition, and then the toolbox, the toolkit. As you say, Gregory, there price stability definition below but close to 2% is strange. It seems asymmetric. It seems a bit ambiguous. Perhaps you can talk a bit through some of those problems. I mean, it seems to me like the ambiguity is a huge problem, because below but close to 2% might mean 1.9% to some members of the governing council and 1.6% to other members of the governing council. And I wonder if that means that debates on the council are actually about the target of monetary policy rather than how best to achieve it.
That's so true. I agree that the ambiguity is not necessary, and we should really end this ambiguity. There is no need for room of interpretation. And actually, in the executive board itself, they have tried to change that for a while. I think Otmar Issing already in 2003 was trying to say that below but close to 2% is something like 1.8. But still, the market do not really believe them. And sometimes, and also because some other members of the governing council, generally like from northern countries, the Netherlands, Germany, etc., they try to keep this ambiguity and say, maybe 1% is actually compatible with our mandate. I think that's problematic. While on the other end, people like Draghi, who have really tried to emphasize the symmetry around 2%, or even now Lagarde, so they are contradicted by some of the members of their council. So I think that's really problematic. And I think this is really the main thing that they should do, because the thing that we observe is that every time there is a crisis, because of this ambiguity, you see that markets start to doubt the level of the target, and you see market expectation actually going down, generally even more in the eurozone than in other jurisdictions, which show that this imprecision about the target is quite damaging for the ECB.
Luke, when we did our episode on the Fed's policy review, and they obviously adopted an average inflation target, at that point you were actually a bit disappointed that wasn't bold enough, and the ECB may well be even less bold than that. in your opinion, what's the ideal redefinition of the price stability mandate that you would like to see?
So I think the most important thing that I'd look for in terms of the property that this definition would possess, that it would have this sort of memory to the system that I've talked about, that bygones aren't bygones, and that if you fail to meet your objective this year, so be it, try again next year, because that does open up these huge gaps that I've talked about, given it does seem that there isn't this symmetric distribution of shocks of higher and lower inflation. We are systematically skewed to lower inflation outcomes. So some sort of system that requires you to make up, to catch up for past misses, both to the upside and the downside. And one way you can do that, as you said, is sort of the average inflation target that the Fed's adopted. And that is a relatively weak way insofar as it leaves unexplicit, how big the window is that you're averaging over. You could end up with a relatively small window that you're averaging over, which is a much less powerful tool. And it also doesn't commit you to how long it would take to make up. So there is a little bit less certainty about where the price level ends up under that system. And granted, I mean, since we've done that podcast, I think the Fed has probably stretched their AIT framework as further than I might have originally worried. And it does seem to be closer to a price level target, but still it's not quite as explicit as that. So I think, what I would truly prefer would be something like a true price level target, which did very clearly set down how long it was that the central bank had to make it up and provide much more certainty about where the price level would evolve over time. Ultimately, it is the price level that's important for households and businesses and other economic agents when they're making long-term decisions. So anything that provides clarity about that is important. I think in some jurisdictions, a nominal GDP level target would probably be even more optimal. I think that has some really nice properties in terms of how it forces the central bank to deal with demand and supply shocks, but that's probably much harder to do in the Eurozone, given that potential growth across different Eurozone member countries is probably quite different. And so sort of the nominal GDP you'd get across those different countries could be quite significant. So that's probably a bit of a stretch for the ECB.
And then, Gregory, that might be the ideal, or at least as Luke sees it, but it strikes me that what's actually going to happen, or most likely, is simply a redefinition from below but close to 2% to just 2%. Is that your expectation?
Yeah, I think on the level, I think a symmetric 2% is where they will try to go. Like Luke, I also think it would be good to go further than that and maybe change. Now they say the horizon is over the medium term. I would prefer also something like on average, which is a way to go towards the price level targeting, but in a easier way for the ECB, because they don't need to change totally and they can keep the 2%. But yeah, I don't think they will go as far as that. I would like them to go as far as that. Actually, I have advocated for an average inflation targeting framework as soon as 2018, before it was
before it was cool.
and before it was chosen by the Fed. But still, I think it's gonna be very difficult for the governing council to decide on that. There is too much disagreement about that. So I don't expect them to go as far as that. Even if I think, an average inflation targeting, and in particular the US version of it, which is a flexible average inflation targeting, where basically it's kind of asymmetric. You do a bit more when inflation is too low, but of course, if inflation is too high, you don't crash the economy because of that. So I like this discretion and this flexibility, but I don't think they are going to go for it.
So let's touch briefly on restocking the monetary policy toolbox then. As you said earlier, Gregory, a lot has changed in terms of the tools that the central bank uses now: negative interest rates, quantitative easing, forward guidance, its TLTRO program. I mean, there's a lot to talk about here potentially, but I wonder if the key aspects are: will they make the additional flexibility of their QE program, or its latest incarnation, the PEP, permanent? That strikes me as one key decision. And another is perhaps, will they spell out more clearly the floor of negative interest rates if there's a reversal rate, if that policy is effectively done at this point? And what are you expecting from the toolbox?
On the asset purchase, I expect the PSPP, so the public sector purchase program, to be really a permanent tool. And they have been trying to say that, but it's resisted in some quarters. So I think, it's good if that is permanent. The PPP is going to be more complicated to make it permanent. As its name suggests, is Pandemic Emergency Purchase Program. So it's not supposed to be permanent. And I think there could be some legal issue with making it permanent. Because actually the European Court of Justice, in 2018, they ruled about the other one, the PSPP, and they say that this was acceptable as long as it was temporary and limited. So making the PPP, which is maybe a bit too flexible, going away, at least temporarily from capital keys, etc., making it permanent is going to be complex. I sure hope that the ECB is going to continue to play this lender of last resort for sovereign that it played first with OMT and now with PPP. I think this should stay, but you don't need the PPP to be permanent to do that. You just need to activate it when there is an emergency and when spreads are deviating from fundamentals. So I think, PSPP should be permanent. PPP should be used whenever it's needed, and PPP in particular should be used when there is basically a big common shock like the one we had, while OMT should be used as a lender of last resort when there is a really country-specific shock and one country only is concerned with this problem of bad equilibrium. So that's on the asset purchase. Your second question was on the rate and the negative rate. I think making the deposit rate more negative might not bring a lot and might not have a lot of effect. Indeed, there could be at some point a reversal rate, and the negative impact on profit of bank could be too large for this to have a positive effect on the economy, and in the end could give them the incentive actually to reduce their lending. So I think on the deposit rate and making it more negative, we don't have much margin there. However, as you know, the ECB has been using actually quite discreetly another tool, which is making the TLTRO rate, so the rate on its long-term operation, more negative than the deposit rate. Some people have called that the dual rate, which is basically you provide really a direct incentive for banks to lend to the real economy, because they make some money if they increase their lending, because basically they receive some compensation from the ECB if the TLTRO rate is below their deposit rate. So that could be used more forcefully. On that, there is no reversal rate. It's clear that the ECB could, now they are, I think, still at minus 50 basis points below the deposit rate. They could clearly, in my view, go to minus 100 if needed, or even minus 200. The only problem at some point is that someone in Germany will realize that and realize that the ECB is losing some money on this and could ask the German Constitutional Court to investigate. That's the main problem in my view. It's more of a legal issue, but from an economic perspective, I think using dual rate and having a TLTRO below this deposit rate could actually be a useful tool to use in the future.
Yeah, that's fascinating, Gregory. And for our listeners, we should explain the TLTRO rate that's currently set at minus 1%, so lower than the deposit rate. And what it effectively means is that the ECB is lending out to banks at minus 1%, so paying banks or 1% interest rate to take loans from the ECB. And then the deposit rate, the rate that the ECB pays to banks who then deposit with the ECB overnight, is minus 0.5%. So commercial banks potentially earn this kind of spread from the ECB, which is why, as you say, Gregory, there's no lower bound. You're not harming the banking sector by taking the TLTRO rate lower. You're actually positively helping the banking sector. So that's why there's this fascinating debate about whether that's increasingly the marginal policy interest rate that the ECB can keep pushing lower. Okay, well, we're going to end the first half of the discussion there. The other big area that the ECB's policy review is getting into is climate change and what the ECB can do as part of the fight against climate change. And let's hear a clip from Christine Lagarde talking about how she sees the ECB's role in climate change.
climate imperatives are nothing less than imperatives. And I have said repeatedly that it is the biggest challenge that is addressed to us. Hence, in my view, any institution, whatever its mandate, whatever its remit, has to question itself and wonder what can be done. Now, obviously, an independent central bank has to deliver on its mandate. And we need to do that, and we need to look at what we can do in compliance and in respect of our mandate, without overinterpreting the mandate, using this primary objective, which in my view justifies fully that climate change matters be actually taken into account for various reasons.
So Gregory, why don't we start this part of the discussion with whether monetary policy has a role in the fight against climate change in the first place? Why is this something that monetary policy makers, and particularly under Christine Lagarde, the European Central Bank, are interested in getting involved in the first place?
First, because the fight against climate change is a priority for all. It's a priority for basically all human beings if we want to avoid a catastrophic outcome. So all public policies should be mobilized in that direction to fight climate change. So from an economic perspective, I think the most important thing that we can do about climate change is basically to finance green activities and to disincentivize brown activities. And in that sense, given its central role in the financial sector and in the banking sector, the central bank and the ECB in Europe have some tools that could actually help finance green investment and disincentivize brown investment. So in that sense, the ECB, because of this central role, can play a role in that fight.
And let's get into the tools the ECB has in that fight against climate change in a minute. But you were talking in the first half, Gregory, about the legal challenges to some of the ECB's policy toolkit. And one can imagine that there will be some pressure on the ECB to justify within its existing mandates why it's going to take a role in the fight against climate change. So I wonder, therefore, how if you see it falling under the primary mandate of the ECB, which is to maintain price stability, that's its inflation target. So is climate change a direct inflation issue, or does it fall under, say, that secondary mandate, which is supporting the broader economic objectives and principles of the European Union? How are they going to legally sort of put this into their existing mandate?
I think putting it in the primary mandate is a bit of an overstretch, in my view. Of course, it will have an impact on inflation at some point because it will have because climate change will have an impact on growth and therefore on inflation, etc. But it's in the long term. Generally, when you talk about the primary mandate and price stability, it's in the medium term, which the ECB defines as like 18 months. And I don't think there will be an impact of climate change in the next 18 months. So it's kind of an overstretch to put it in the primary mandate. So it falls better in the secondary mandate. But then again, the problem with the so-called secondary mandate, there is not even a secondary mandate. There is just the article of the treaty that says that the ECB should participate to the general economic policies of the Union and help the Union to fulfill its objective. And then those objectives are defined in the treaty, but they are very broad. They go from full employment, sustainable growth, environmental protection, but also innovation, equity between citizens, etc. So there are millions, not millions, but tens of objectives of the EU. And so it's difficult because the ECB, if it wants really to help the Union to fulfill those objectives, it will be involved in everything, which is not possible because it has a limited number of tools. So I think there might be an issue, and actually recently I've been publishing an op-ed with a few academics where I was saying that maybe the ECB needs some political guidance on this, because if it starts deciding between those objectives itself, it's kind of taking political decisions. So yes, fight against climate change is one of those objectives of the EU, but there might be trade-offs. For instance, there could be a trade-off between full employment and climate. because some job could be destroyed if you do forceful climate change fight. So in that sense, I think they could do it under the secondary mandate, but they need some guidance, and someone, in my view, need to tell them that this is at the moment the most important objective of the EU. Otherwise, they are taking political decisions. And if I may, a third thing. Actually, it's often forgotten, but the ECB also have a financial stability mandate, especially since 2014 when it became the main supervisor of the banking sector. And I think they could do something there, actually. And that might be even the most important thing in my view, because climate risk is a financial risk. And it's a financial risk for the bank who invest in brown assets. And we know that if actually the transition become quicker, some of the assets and some of the loans that those banks have in their balance sheet might lose value. They might depreciate quite quickly. So that's, in my view, actually, it's a bit geeky. People prefer, we'll discuss later, green QE and stuff like this. But in my view, actually, its supervisory role and his mandate for financial stability might actually be the main and the most important way to deal with that issue.
Yeah, I think that's a very well made point. The supervisory role is a very important when it comes to these climate considerations, because all these physical transition risks, they will affect the fair value of assets. They will cause potentially impairments on banks' balance sheets. They will also affect insurance liabilities in the balance sheet of insurers as well. I mean, maybe a fourth sort of justification, it's not a technical justification, but a way I think about it is that this is the ECB's way of being radical in its strategic review. It's probably not going to do anything particularly radical on the price stability redefinition. The Fed was about as radical as we could have got there in terms of moving to its average inflation target. So this is the way that the ECB strategic review is going to sort of really push the boundaries of central bank thinking by really thinking seriously in a way that arguably the Fed hasn't. The Bank of England more recently has started to do, to think about a central bank's role in the fight against climate change. So Luke, Gregory was making the point there about the importance of a democratic sort of underpinning or justification of this role. And you've spoken a bit before about the potential for technocratic overreach when it comes to a technocratic organization like the ECB getting involved in what are arguably public policy decisions. I mean, do you want to lay out your thinking there?
I guess there's a few things to say about that. I mean, the first is, I suppose what I'm skeptical of is sort of a technocratic justification for ECB policy on these grounds. So that's sort of like the doing it under pillar one, that the reason we need to tackle climate change is precisely because that's just what our mandates require, and shoehorning it under that I'm pretty skeptical about, because yes, no doubt climate change does and will affect growth and inflation over the long run. But look, a lot of things do that. And normally what we think is that it's the ECB's job or the central bank's job to respond to those shocks as they come in, rather than sort of preemptively go out and shape them and set policy on those matters, right? It has to deal with fiscal policy as it's set. We don't often think it's the job of the central bank to set fiscal policy, even though it clearly affects its objectives. So to put this in slightly extreme terms, right, it's pretty clear that war also affects growth and inflation, right? But we don't think the ECB should be involved actively in setting foreign policy on the basis it affects growth and inflation. That being said, clearly, actually, when a society is in total war, the central bank is mobilized, right? During various world wars, we have used the central bank to help the government finance its deficits or ensure that it can fund the war effort in some way, right? And so this sort of speaks to the point that, yes, actually, when we have great social, civilizational struggles, as it were, it's perfectly appropriate to use the ECB, but you use that explicitly, or use the central bank, but use that explicitly on those terms, rather than try and shoehorn it in as some technocratic, well, really, this is all about growth and inflation. Be explicit about what it's about.
Brilliant. So let's talk, Gregory, about what the ECB can actually do in the fight against climate change. And I mean, I see a few different levers it can pull. Perhaps a boring one or a not so exciting one is that its forecasts could be explicitly conditioned on alternative climate scenarios, but maybe it's very long-term forecast. I feel like that would be a good way of the ECB highlighting this as an economically relevant issue. And we've had previous podcasts in which we've talked about the very divergent economic and market paths conditional on alternative climate paths. But the one that everyone really talks about is the balance sheet, the ECB using its QE programs for green aims. Could you explain sort of what can be done there?
Yeah, on the forecast, actually, I never thought about that because I think that the forecasts of the ECB are too short term to do that. If they had like long-term forecast, a bit in the way that the Fed has these long-term views of the member of the FOMC, maybe they could do that. But at the ECB, they don't have this. So the forecast could be a good way, but you would need to change also how forecasts are formulated, which is also could be part of the strategy review.
Indeed.
As far as the balance sheet is concerned, yeah, the obvious one, the one that is discussed generally by NGO, etc., is asset purchases, and they are mentioning green QE and all of that. I think asset purchases are not the best tool because, in my view, asset purchases are a tool to deal with the business cycle. They are a tool to deal with inflation that is too low. And therefore, and the problem is that climate change is not related to the business cycle. It's something that is not temporary and cyclical. It's something that is going to be with us for the next decades. So green QE, okay, it can help when we have QE and when we increase asset purchases when the business cycle require it. But it's not, given that it's a temporary tool, and as I said before, from a legal perspective, it needs to be a temporary tool. I don't think it will help that much. Of course, for instance, the corporate part of the asset purchase could be changed a bit to incentive to have more bias towards green assets, but it would be small and its effect would not be that big. The second part of the balance sheet tools that could be used is actually the collateral framework. When the ECB lends to commercial banks, they are asked to put some collateral for this lending. And this is like a permanent feature. They are borrowing from commercial banks at the ECB all the time. So it's of course it increases during recession, etc. But still there are monetary operation all the time. So I think using the collateral framework might be a better way to do that. And a way to do it, for instance, would be to change a bit the haircuts. To have because the ECB, when it takes collateral, it applies some kind of haircut depending on the risk of the asset that is put as a collateral. And maybe they could try to have a bigger haircuts for brown assets and for green assets. And this could be justified by what we were saying before, by the fact that there is some kind of financial risk on those brown assets. So it's perfectly justifiable from a risk management perspective to apply a bigger haircut to brown assets. So I think even though it less sexy than green QE, I think green collateral and green haircuts might be actually a better way to deal with that situation.
And maybe another technical tool, it's not a balance sheet tool, it's more a supervisory tool, could be setting the risk-weighted capital banks hold against green versus brown loans. And do you see that as another tool similar in a way to the differential haircuts applied in its collateral operations that could also be a tool of the ECB?
Yes, the justification would be the same. It's like you're taking more risk by lending to this for this brown activity, and therefore the capital requirement could be higher. So that's indeed one way to do it, but this time not from a monetary operation perspective, but more from a supervisory side of the ECB. So yeah, the two are complementary, and actually it would make sense to use both at the same time. Actually, there would be no justification to do one but not the other. So. I agree with you. This should be done too.
Great. And Luke, one of the potential hurdles the ECB has to overcome is the question of whether it's violating market neutrality. Now, this would primarily apply to green QE rather than the collateral obligations and capital requirements that Gregory was talking about. But how do you think the ECB best rebuts this criticism that, as soon as you're doing green QE and preferring some bonds over others, you are violating market neutrality, which has been sort of quite a long-held principle justifying the ECB's QE programs?
So I think it's pretty obvious that it is non-neutral, right? So then the question becomes, is that such a bad thing? So I guess the reason that central banks used to care, or indeed still on some level care about neutrality, is this idea, look, we set the macro economy, we ensure that inflation's at target and we have full employment, but we're not interested in allocating across sectors, in making this sector stronger or this one weaker, or to put it in 1970s industrial policy language, picking winners, right? And there are several reasons why the central bank might be adverse to that kind of microeconomics. One, because they might not be very good at it. You think that the market would be better allocating resources, and it could end up quite inefficient to pick that sector over that sector when it turns out that that really wasn't the sector of the future, or whatever else it might be. Two, to the extent to which you do want to deviate from where the market is, well, that seems like it's a political decision. It's the kind of thing that a democratic body should make decisions about rather than a technocratic one. And third, it might turn out that once you start being non-neutral, preparing one sector over another, it becomes very difficult to stop. Once political bodies realize that central banks have this kind of power, perhaps they come knocking on that door quite often, wanting the preferred sector to be supported. And that could end up, I suppose, sort of running against some of your other objectives. So that's sort of why you might want to hide behind this screen of neutrality, why it might be a useful thing for the central bank to claim. But yeah, as I say, I'm pretty skeptical that any operations that the central bank does are truly neutral in the way that they might pretend. I mean, even in a world where we were just setting the risk-free interest rate, and that was meant to be neutral because, well, the risk-free rate sits in every asset, so it filters across everything. Even that kind of world doesn't seem that neutral to me. But even granting that, once we're in a world of all the toolkits measures that we discussed earlier, it's pretty clear that the way in which you construct your policy response will tend to prefer one sector over another. So how much liquidity provision you do versus how much balance sheet you do versus how much you cut rates, to the extent to which these are substitutes and you might do more of one and less of the other as you set your macro policy, well, all of those affect different sectors in different ways. Some help the banking sector more, some help capital markets more. Once you do QE, well, already, you have to make a decision about which bonds you buy and in what basket and what proportions. You might think we'll just follow the market benchmark, but the ECB doesn't actually do that. It follows according to capital key and then sometimes violates that on the basis of market conditions. That's not obviously neutral. That's making decisions about which markets to support and which to buy more of. When you buy corporate credits rather than equities, that's not neutral in the sense that some companies tend to systematically fund in credit markets more so than in equity markets. And indeed, bigger companies are just those that have access to capital markets. So there's all sorts of ways just in setting monetary policy and using the various tools that it has, that it's implicitly favoring one sector over another. So as much as this neutrality defense sounds good, I think they've already long violated it. So at that point, once you realize that neutrality is impossible, then the question just becomes, okay, in which way should we intervene rather than should we intervene at all? And once you've got off the ground with that, then you can start asking questions about, well, climate change is an existential thing. Of course, the ECB should be non-neutral in that way.
Great. So why don't we end, Gregory, then with maybe spelling out explicitly how all this is actually helping the fight against climate change. And what we're trying to do here, what the ECB would be trying to do, is change funding costs, right? Is make certain types of investment more expensive than others and therefore less attractive over time, and sort of direct funding in a way into greener parts of the economy. That's the mechanism ultimately we're talking about, right?
Yeah, that's the mechanism. And actually, it's not such a huge mechanism. I have seen some simulation on that. And actually, changing the collateral would help the green asset by a few basis points here and there. I don't think it can help, and it will show that the ECB is doing something as a public institution is doing its part in fighting against climate change. But it's not the main tool against climate change. People need to be clear about that. And basically, central bank cannot replace government who have the duty to deal with climate change. I think there are much more important tools to fight against climate change than any tools that the central bank will use. Of course, the carbon tax is much more important to change people's incentive in their daily life. So that will be major. On the financing side, actually using tools like the European Investment Bank or the National Development Banks that now a lot of European countries have is actually much better to help finance green assets. Or of course, public investment and fiscal policy are much more powerful to help do green investment. So yes, the ECB can do, but anyway, it will be small, the impact. So I think, yeah, we need the ECB needs to be clear about that, and do not say they do not try to replace government.
Brilliant. And I should say, Steph and I have plans to cover a lot of these questions about the economic tools, the government tools, the market implications of the fight against climate change in upcoming podcasts. But Gregory and Luke, thank you both very much. That's about all we have time for this week. Thank you for listening to Macro Matters. Remember that we have a mailbox, macromatters@aberdeenstandard.com, if you'd like to get in touch with suggestions for the podcast. Don't forget to like or subscribe on your podcast platform. We're now on Apple Podcasts, Spotify, SoundCloud, Google Podcasts, Buzzsprout, and a variety of podcast platforms. But until next time, goodbye and good luck out there.
Please note that email is not a secure form of communication, so don't send any personal or sensitive information. This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.